It's a great time, guys, we meet for this session. So we are doing the partial disposal of subsidiaries. So under advanced financial reporting and analysis. And this is the question of today. So this is a question of December 2012, question 1. So whereby you are told that Hunga Limited, a company quoted on Securities Exchange, acquired 80% of Shika several years ago. On 1st January 2012, Hunga Limited sold a half of its investment in Shika and acquired 75% of the equity shares of Shuja. The financial statements of the year ended 30th June 2012 for the three companies are given below. So we have the statement of comprehensive income, then we have the statement of financial position. Additional information, Hunga Limited had acquired its shareholding in Shika for 2,400 when the retained profit of Shika amounted to 1,500. There was no fair value adjustment in the time of this acquisition. Hunga Limited, that is number 2, Hunga Limited sold half of the investment in Shika for 1,500. This disposal has already been accounted for by Hunga, but not by the group. The fair value of the remaining investment in Shika was 1,300 on the date of disposal. Number 3, between 1st January 2012 and 30th June 2012, Hunga Limited sold to Shuja Limited goods worth 500 million, reporting a profit of shillings 100 million. Half of the goods were still in the inventory of Shuja as at 30 June 2012. Intercompany receivables and payables were as follows as at 30 June 2012. Due from Shika to Hunga, due from Shuja to Hunga. Number 5, as at 1st July 2011, half of the goodwill of Shika had been impaired. The goodwill of the companies were not impaired in the current year to 30 June 2012. The group uses the partial goodwill method when preparing the consolidated financial statements. So let's look at this question. This is June 2012, question 1. So at the start of this question, you can see they were saying, it's December, not June, December 2012, question 1. Hunga, a company quoted on Securities Exchange, acquired 80% of Shika several years ago. Then now, on 1st June 2012, he did what? He sold a half of the investment and acquired 75% of the equity shares of Shuja. So meaning that initially it was an 80% subsidiary. Then that subsidiary was disposed by what? By half. So meaning that the investment reduced from 80 to 40. So it changed from being a subsidiary to be an associate. You know those percentages. Then they acquired a new company called Shuja, which is a 75% subsidiary, you know, more than 51% shareholding, that is a subsidiary. So meaning that we will consider Shika for some months being a subsidiary and some months an associate. Then Shuja will consider it to be a subsidiary again for some months. Remember, our financial year ends 30th June 2012. 30th June 2012. So what you do, you have to interpret the structure first. So you say here, Hunga acquired Shika sometimes back, 80%. So this is just before disposal. This is what happened before any disposal took place. This is before disposal. So meaning that after the disposal, what happened after the disposal? Hunga sold a half he sold a half of Shika and acquired, so meaning that this reduced it to 40%, and he acquired Shuja. Shuja meaning this is 75%. So we need to check the time when Shika was a subsidiary and an associate. Then Shuja, the time it was what? The time it was a subsidiary. The time it was a subsidiary. So our financial year ends when? According to the question. So according to this question, our financial year ends on 30th June 2012. So 30th June 2012. That is when our financial year ends. 30th June 2012. So if the year ends on 30th June 2012, it starts on 1st July. So the year was starting on 1st July 2011. When did they dispose? When did they dispose Shika? Tell me. When did they? When did this?
January
1st January
2012.
So 1st January 2012. So that is 1st January 2012. So 1st January 2012. And this is the same time when they acquired who? This is the same time when they acquired who? They acquired Shuja, because once they disposed that company called Shika, they acquired Shuja. So meaning that from July to January, how many months? So this is 6, this is 6. Meaning that Shika was a 6 months subsidiary and 6 months associate. Because from this time towards the end of the year, it was a 40% associate. Then from the start of the year up to 1st January, it was a subsidiary. Then, what about Shuja? For Shuja was acquired immediately when the disposal took place. So meaning that it existed from this time. So it's a 6 months subsidiary. So what we do here, we write Hunga Limited, consolidated income statement. So that is for the year. For the year ended 30th June 2012. 30th June 2012. So we start from revenue. We start from revenue. So the revenue, what would I do? Let me, for example, guide me now on how to consolidate revenue, because these are things we have been doing from time to time. What am I supposed to record here?
$8,000 plus
6,000.
Plus
4,500 times 6/12.
So 6/12 times 4,500 plus
Again, 6/12 times 6,000.
6/12 times 6,000. Yeah, that is correct. Because now the two companies, Shika and the Shuja, they were subsidiaries for 6 months. So you have to apportion the items of those two, so that you consider 6 months subsidiaries. What am I supposed What am I supposed to deduct? Under revenue,
The group sales.
which is according to our question, then the group sales is, I'm sure you have the question, so I need the answer from you guys.
Is it 500?
So it's 500, eh? So 500. So that is according to additional information. You were told that additional information number what? I always assume that you have the question. That is why I don't want to display it from time to time.
Number 3.
So that is number 3. They were talking about that there was a sale. That is between January 2012 and 30 June 2012. Hunga Limited sold to Shujaa goods worth 500, reporting a profit of 100. So the intergroup sales is just 500. 500. So we minus 500 here. And we are done with revenue. Then we talk about cost of sales. We talk about the cost of sales. So now, since you know that we apportion the other companies for 6 months, I can be able to record this. 3,000 plus what? 6/12 times 2,000 plus 6/12 times 2,000 minus the 500, the same 500 plus the UPS. UPS on the goods which were sold. So the other entity which received these goods, did he resell all of them by the end of the year? You were told that when the entity who sold the goods, like now here, in note 3, you are told that it's Unga who sold goods to Shujaa at 500. He made a profit of 100. Half of the goods were still in the inventory of Shujaa. Half of the goods were still in the inventory. So meaning that for you to compute UPS, you take unsold goods. Unsold goods times what? Times profit margin. Times profit margin. Unsold goods times profit margin. Unsold goods is half of 500. But now you are not given margin. The best thing here, you are given profit. So to get this, once you are given profit, and then you know the selling price, you take that profit, you divide the selling price. And that is how you get a fifth, being your margin. So this one is 50. So selling price over, that is profit over the selling price. It will give you profit margin. So UPS on closing stock, we add. If there was UPS on opening stock, based on the goods which were sold on the previous year, I could have deducted. Then I could have considered depreciation under charge and depreciation over charge, of which depreciation under charge is due to revaluation. There's no revaluation here. And the depreciation over charge is due to sale of fixed asset. There's nothing like that in this question. So meaning up to this point, we can be able to get gross profit. Because once you take your revenue minus cost of sales, what you get here is gross profit. I think you are computing for those answers. Then the next thing here is other incomes. I can say there is other incomes. So other incomes, we have dividends. We have the dividends. So dividends. So the dividends under the parent is 380. But these dividends, which the parent recognizes as income, they are obvious from the other companies. They are from the other investing companies. And if they are from the other investing companies, because I will check after the profit after tax, did the other companies pay, did they pay dividends? So yes, if there is a dividends paid by investee companies, it means that this is what the parent recognized. And that is not supposed to be the case. So if the parent recognized this as presented in that income statement, we need to deduct those dividends which were paid by the other investee companies, including if there is interest, you deduct. So if I go to the income statement, after the profit after tax, Shika paid a dividend of 200 and Shuja paid 400. That is what I deduct here. 80% of the dividends which Shika paid 200, but remember Shika was disposed by half. Then you minus again 75% times 400, the dividends which Shuja paid. So for the gain or loss on disposal, we need to do a wiki. Gain or loss on disposal, that one we need to do a wiki. Gain or loss on disposal. A working is needed for that. Then after that, if we get a negative goodwill, we can consider it recording it at this point. But on some cases, when you are doing statement of changes in equity, record goodwill at that point. Since this question, we don't have statement of changes in equity, the negative goodwill, which is up again option, I will add it back under income. It will be based on the goodwill, which I will do. If there is no negative goodwill, I will just write dash. Then after that, we have distribution. After this, I have a distribution cost. Which content is hidden? There's content, there's no content which is hidden. Which content is hidden? Which one? I'm on here, but there's are you not seeing the gain or loss on disposal? I want confirmation from the other students. Because on my case, remember that I always see my screen before you see it. The same thing you are seeing, I'm seeing it. That is why sometimes you see I'm looking at the laptop. So, hii content yoku chini ionekane. Christine.
Inaonekana kwangu.
Oh, so Mary, maximize your screen. That is the issue. I know. Maximize your screen. So distribution cost. So distribution cost, that is 1200 plus. So for the others, we apportion. So 6/12 times 600 plus 6/12 times 800. So dividends, I've said, you see these dividends, Michael, these dividends recorded under the parent, they include those dividends paid by the investee companies. Investee companies is just Shika and Shuja. So we deduct at this point the dividends paid by other investee companies. And those dividends paid by other investee companies is just the dividends which are immediate after the profit after tax. That is what I've deducted here, considering that Shika was disposed by half. Then distribution costs, we have 1200 plus the others, your portion for 6 months, 6 months. You prorate. For admin, you do the same. Admin, we talk about 1,800 plus 6/12 times what? Times 800 plus 6/12 times 1200. And what I'm supposed to introduce here is what we call impairment loss, and this is based on our working, which I will do. Up to this point, I will get profit before interest and tax. Profit before interest and tax. So interest is all about finance cost. So the finance cost, that is 200, 100 and 100. So 200 plus 6 over 12 times 100 plus 6 over 12 times 100. Then now, before I talk about tax, there's this income which I have not recorded here, because we have to record all the incomes and expenses before we consider tax. So which income have I not recorded? Remember that Shika, for the last 6 months, it was an associate, and the parent is supposed to be entitled for a certain income from that entity for the period it was an associate. So for the last 6 months, the parent will be entitled to 40% of the profit after tax in Shika. So here I will say share of profit after tax. Share of profit after tax in Shika. But as what? As an associate for the last 6 months. So you say 40% of the profit after tax in Shika. So the profit after tax in Shika is 700. That is 700 times what? 6 over 12. So that is an income to the parent when Shika was an associate. So that we say profit before tax. I have not considered the tax of the parent and the subsidiary. So here I would say income tax of the parent and subsidiaries. So tax, 600, 300, 500, 600 plus 6 over 12 times 300 plus 6 over 12 times 500. So that we have the profit after tax. Then after that, we say profit attributable to NCI. So that is our working we do. Then we say profit attributable to parent. So as a student in an exam, this is what you are supposed to do. If you do this out of the, I think this question was having 10 marks, you have 8. The income statement was having 10. Already, you could have scored 8 out of 10. Entries is what they require. So is there anybody who has been computing so that they can record the answers? So some of you are in Matatus, 12,750. The second one. So the second one is a 3,000 plus 6 over 12 times 2. That is anyway. This is 3,000 plus 1,000 plus 1,000. 5,000 minus 5, 45, 4550. 12,750 minus 4550. 8,200. 80% of 200 times a half, that is 80. That is 380. So this is 0. Yes.
Hiyo 380 ulipata aje?
This one. This one is from the income statement.
Is it not 500?
Sorry?
Is it not 500?
500, where? Dividends of the parent and other incomes. There is that 380. Or which dividends are you talking about?
Okay.
I'm talking about these. I see what you are talking about is the dividends paid by the parent. Me, I'm talking about the income. You see these. This one is the dividends which the parent recorded as income. This 380 includes 200 and this 400. That is what I've deducted from there. That is what I've done.
Okay.
This one will be deducted under the retained earnings, the dividends paid by the parent. It doesn't affect this income statement at this point. I think that is okay. And then this one is 300, 719. 400, 600 plus 1,020, that is 2,800. This one we need a working, this one. Even gain or loss on disposal. And 200 plus 100, 300. So this one we need to check. So 350 or 40% of that, 140. $150, $250, $150 plus $250 plus 600, that is 1,000. So we do the working, so we can decide to do gain or loss on disposal. So the gain stroke loss on disposal. So we start with sales proceeds. We raise what? We deduct what? Remember, I'm looking for the gain or loss on disposal. Oh, Shika. What am I supposed to deduct here? Guys, what am I supposed to deduct? What am I supposed to deduct?
Share of net assets is first.
Share of net assets. Then after this,
And impaired goodwill is first.
so we talk about an impaired goodwill, disposed. Then we raise dividend.
Dividends and disposed. Okay.
So sales proceeds when who? When sugar was disposed, according to additional information, that is additional information number 2. You are told that Unga Limited sold half of the investment in Shika for 1,500. So that is the sales proceeds. So for assets, I will look at the one which are in the statement of financial position under the equity part. So there are 1,000 and the 3,000. But remember, the retained profit must be as disposal date. So I will analyze to get the figures as a disposal date. So this one is 1,500 proceeds. What about net assets? Share of net asset disposed. I think we can do the working here. So share of net asset disposed. So there's that aspect of ordinary share capital. There are 1,000. We have the retained profit. But the retained profit, I cannot pick the 3,000 because I need the one as disposal date. As a disposal date. So remember that it was just 6 months, 6 months. So you check the profit brought down, carried down, and for the year. And the profit for the year. So the brought down from the income statement, are you seeing 2,500? The second last item in the column of Shika. And this is 3,000. Then profit for the year is just profit after tax. That is profit, not after tax, but profit for the year, which is 500. Eh? So I'm talking about these figures. Eh? So they brought forward, carried forward. Then we have for the year. So meaning that we need the one as disposal date, which was, I think, 1st January. It was 6 months. So I can decide to take 2,500 plus the 6/12. This one, I prorate it for the first 6 months. I add it to the balance brought down. So 25. That one would be 3,000. Or I can decide to do it. Let me check again if I picked the right figures. So it's 25 years.
750.
Sorry? So this is not 3,000, but 2,750. Eh? Because this is 250 plus 25. Or you can decide to take 3,000. You minus, there are 6 months, minus 6/12 times 500. So you can minus that 25. You can minus the half of 500 from the 3,000. Again, you will remain with the first 6 months. Is 2,750. So as at this time, meaning that from the start of the year up to the time of disposal, as the disposal date, the first 6 months. So this is 2,750. So the total here is 3,750. So that they disposed. So the parent was controlling this 80% of 3,750 times half. So they disposed the half. So this is 1,500. Eh? 1,500. And impaired goodwill disposed, we do goodwill. Start okay. I clear this. So we talk about goodwill. And remember that goodwill is all about purchase consideration minus share of net assets. So here we have a Shika. We have Shujaa. Because I'm talking about Shika and the Shujaa, I want to do the goodwill for both. Why? Because we are using partial method. We are not using full method. That is what you were told in additional information number 5. There are sentences. The group uses partial goodwill method. But even if you were not told to use partial, you know on which point you use full method. You can only use full method when the fair value of the NCI, the fair value of the minority shareholders, the fair value of the minority shareholders is provided. So purchase consideration. So when Shika was acquired, they paid how much? That is not 1. Hungary Limited acquired its shareholding in Shika for what? 24. Even if later they disposed half, we know that initially when Shika was acquired, they paid 2,400. What about Shujaa? I can even display the question for you to tell me what the. So for note 1, you were told about Shika that Hungary Limited had acquired its shareholding in Shika for 2,400. What about Shujaa? Someone? I think out of the 20-something students who are in this session, there's someone who can answer this.
1,800.
So the 1,800, eh? So the 1,800, this one, the investment is this. So why is the investment in Shika 1,200, not 24? Why? Why is it 12, not 24? Because
Maybe because it was disposed of.
yes, remember that, correct. Very good. So the statement of financial position is prepared as at the end of the year. These items recorded here is as at the end of the year. So as at the end of the year, Shika had already been disposed by half. So meaning that their investment by the time of disposal, it's supposed to be 1,200. That is why they have provided that. So that meaning that here we talk about 18. So less we deduct share of net assets acquired. So we have ordinary share capital. Remember that for Shika, we'll be using 80%. For goodwill, we always compute it based on the time of acquisition. Eh? So then for the other, so I will just mention anyway, 80% of the ordinary share capital, which is 1,000. It's 1,000. Eh? Both. So here is 1,000. Even for Shika, the ordinary share capital was 1,000. So this is 800. And this is 750. And for the retained profit, remember this one, it has to be as at the time of acquisition. Eh? Or we call it pre-acquisition. When you see other books saying pre-acquisition, retained earnings, it's just the same as acquisition date. So 80% of what? Note 1, you were told when Shika was acquired, the retained profit of Shika was 1,500. What about in Shujaa? So is it 75% of? When it was acquired, the retained profit was? So if they have not given you direct, they obviously give you the date. Remember that Shujaa was acquired immediately on the date of disposal, which was just mid this year. So we need to know the retained profit as at the start, as at the end, and during the year. So we need to know this. So this is 15, 2000. So as at the start, we have 1500. At the end, we have 25. During the year, we have 1000. I'm talking about this. So those are the one I've recorded here. So we need the retained earnings as at this date. So we talk about 1500. So remember this one was 6 months, 6 months. Plus 6 over 12 times 1000. That is 2000. Or if you talk above 25, you minus 6 over 12 times 1000. That is 2000. 75% of 2000, 80% of 1500, that is 1200. 0.75 times 2000, 1500. So another net asset is all about pre-acquisition dividends. Dividends are considered as net assets based on their pre-acquisition period. And if the subsidiary was acquired during the year, that is when you can have a pre, meaning that Shika was acquired a long time ago. So pre-acquisition dividends. So according to the start of the question, this Shika was acquired a long time ago. We can never have a pre. But for Shuja, it was acquired during the year, immediately when they disposed Shika. So meaning that there's that pre-acquisition period of 6 months. And we know well that Shika paid a dividend of 400. That is according to the income statement. After the profit after tax, there's those dividends which Shika paid of 400. So you say 75% of the 6 over 12 times the dividends which is paid by Shika. So 200 times 0.75, this is 150. So we can be able to get our goodwill. Then we check if they are impaired. So 2400. Is a question?
Shika paid dividends of 200.
Shika, not Shika, Shuja. I'm talking about Shuja. So Shika, I have said the only dividends I will consider it's for the subsidiary which was acquired during the year. Was Shika acquired during the year? We can only have a pre-acquisition dividends if the subsidiary is acquired during the year. When was Shika acquired? Several years ago. Several years ago. The only company which was acquired during the year is Shuja. On 1st January 2012, Hunga Limited sold half of the investment in Shika and acquired 75% of the equity shares of Shuja. Shuja is the one which was acquired during the year. So since it was acquired during the year and it paid dividends, we have a pre-acquisition dividends. And we have seen that it paid a dividend of 400. So we don't consider that of Shika because it was acquired long time ago. So the only subsidiary we consider is for Shuja, which was acquired during the year. Then the pre-acquisition dividends, 75% of the pre-acquisition dividends. So 1800 minus 750 minus 1500 minus 150. My calculator is misbehaving. So this is a negative. So negative goodwill. So that is why I recorded this here. So I'm done with this. So what about Shika? Was it impaired in the current year? Remember that our financial year starts when? It was starting on July 2011, because it was ending June 2012. So this goodwill I have computed for Shika is from the several years ago when it was acquired. So by the end of the current year, was it impaired, or by a certain period in that years it existed, was it impaired? But for the impairment to record here is the one for the year under consideration. So looking at my question, additional information number 5, on 1st July 2011, that is as at the start of the current year, not the end of the year, start, a half of the goodwill of Shika had been impaired. So meaning that this is just a goodwill for the time Shika has been in existence. So by the start of the current year, it was impaired by half. What about by the end of the current year? The goodwill of the companies were not impaired in the current year. That is what they said in note 5. So what we write a code here for the impairment, I will talk about accumulated impairment. That is, they are half by 1st July 2011. They are half of 400, which is 200. So an impaired goodwill is 200. They disposed what? A half. So 100. So undisposed goodwill is 100. So we needed what here? Share of net assets disposed. That one we have. Unimpaired goodwill disposed. Unimpaired goodwill is 200. Disposed is 100. And the last one is dividend earned and disposed. Dividend earned and disposed. I think I can clear this. So dividend earned and disposed so you check what the parent earned. From who? Shika. What the parent earned from Shika. So you say the parent earned what? 80% of the dividends which Shika paid. Shika paid 200. So for the 6 months, before it changed to be an associate. So that is what? 80. They disposed of a half. So yeah, you get 40. So you record 40. So meaning that this is 140 loss. So that is what I will minus here. So you say 8200 minus 140 plus 600 minus 1900 minus 28. Remember, for impairment, there is no impairment for the current year. That is what we are told in note 5. So this is 3960. Minus 300 plus 140. So up to this point, we have 38 minus 1,000, that is 28. Then we talk about profit attributable to NCI. So both in Shika and Shuja. It was Shika for the first month, 6 months, Shuja for the last 6 months. So we talk about profit after tax. So we adjust this profit after tax by deducting UPS. If sales upstream. After that, we raise depreciation, undercharge. We add overcharge. And finally, we raise impairment loss. But this one can only be applicable if we use the full method in Goodwill. So remember that we are adjusting the profit after tax in Shika and Shuja. Why am I minusing UPS? Because if the subsidiary sold to the parent and the parent never resold all those goods, out of the goods which are unsold, there's unrealized profit. Meaning that the profit of the subsidiary is overstated by what the parent never realized. That is why we deduct. Minusing depreciation undercharge means that we had did what? Overstated our profit. The same way we add back overcharge, since we had understated our profit, then we minus impairment. The profit after tax in Shika is 700, but remember that we consider it for 6 months. So 6 months of 6 over 12 of 700 is 350. So 6 over 12 of 700. And this one, profit after tax is 1400. So we say 6 over 12 times 14. So this is 700. Did the Shika sell to the parent? Did the Shuja sell? No. The intergroup sales which was there was a downstream sale. Even depreciation overcharge is not there. Even overcharge is not there. Because we said for us to have a depreciation undercharge, we must have a revaluation. For depreciation overcharge, we must have the aspect of sale of fixed asset. And even impairment, it was not there for the current year, meaning that this is 350 and 700. So that NCI profit, you say 20% of 350 plus 25% of 700. So 0.2 times 350 plus 0.25 times 700. So I am getting 245. So that is what I record here. Then 2800, this is 2800 minus 245. This one is 2555. I think up to that point, you're okay. So after we are done with the income statement, now we can consider the second part of the question. So that is consolidated. So we talk about Unga. So Unga Limited consolidated statement of financial position. As at what? 30th June 2012. So we talk about non-current assets. So how would I consolidate these non-current assets? How would I consolidate the current assets?
Parent plus subsidiary, who is now Shika, because is it Shika or Shuja? Shuja, because Shika was disposed.
So meaning that I would just add the parent plus, I would add Hunga and
Shuja.
you cannot talk with confidence. So it's Shuja. We had Unga and Shuja because Shika was an associate. Remember that statement of financial position is prepared as at the end of the year. So meaning that by the end of the year, Shika was an associate. So when a consolidating associate, we just consolidate what we consider it when consolidating the associate. In the statement of financial position, I would consider what? I would only consider
subsidiary.
sorry? I would only consider what in Shika. What would I talk about in Shika? Because I've said yes, I will not add it because it's not a subsidiary, it's an associate. How do we account for associates? Using which method?
Equity.
Method.
Equity method. So I would just say investment in Shika. We use the equity method and record that under non-current assets. But most of the items to add now is just for Unga and Shuja, parent and subsidiaries. Because Shuja is the subsidiary by the end of the year, but Shika is an associate. And the statement of financial position is consolidated as at the end of the year. So I will be adding the items of Unga and Shuja very fast, since you understand that as we make relevant adjustments. So PP 68 plus 6,800 plus 3,000. And you know that we don't prorate subsidiaries, even if they were existing for 6 months, we consider them for the entire period. We consider their full values. If there's revaluation, I could have added here. I minus depreciation what? Undercharge. After depreciation undercharge, we minus UPFA, we add depreciation over. Then after PPE, we consider investment in who? Shika. Investment in Shika. So using equity method, I will do a working for that. So for Shuja, I could have considered goodwill. For Shuja, if it was a positive one, remember it was a negative, we added back in the income statement. So this one is not there. Goodwill of Shuja was negative. Then current assets. So for the current assets inventory, 1,500 plus what? 12. We minus UPS. UPS was 50. Plus, if there was goods in transit, I could have added here. And at the same time, under payables, that is when you record the goods in transit, you add under inventory and under trade payables. So for the receivables, we have a 4,000 plus what? Plus 34. I will minus owings and cash in transit. But between who and who? For now, it's between Hung and Shuja. The outstanding balances between the two companies. So do we have the outstanding balances between the two companies? Number 4. Due from Shika to Hunga. That one we don't consider because Shika is an associate. We don't eliminate transactions with associates. Due from Shuja to Hunga, that is fine. There was a data outstanding balances because they said in note 4, intercompany receivables and payables were as follows. Due from Shuja to Hunga, 300. So this is an outstanding balance, so which is supposed to be eliminated. They don't have to owe each other in the next financial year. So we minus here. This is crediting here. And at the same time, I would minus under payables. If there was cash in transit, I could have deducted cash in transit. Then I add under bank, but we don't have cash which was paid, not yet to be received by the other company. It was not present. For the cash at bank, we talk about 1,000 plus 600, then plus if there was cash in transit, the one I said we could have deducted there. Up to that point, we could have recorded total assets. We talk equity and liabilities. We talk about equity and liabilities. Equity and liabilities, we talk of ordinary share capital. So the ordinary share capital, that of the parent, 6,000. Then retained profit, I will do a working. I will introduce non-controlling interest here. So even this one needs a working. Then I will talk about non-current liabilities. So for the non-current liabilities, we have 10% loan stock. So the 10% loan stock, 2,000 plus 1,000. We have current liabilities. So the current liabilities, we have trade and other payables. Remember, trade and other payables is 2,500 plus 3,300. Here we could have deducted the owings. So there is owings of 300, this one. But we deduct here, meaning we credit here, we debit here. So it's deducting both sides. Then these goods in transit, adding here is crediting, and you add goods in transit here. That is crediting. So this is a debiting. This is a crediting. The goods which were in transit, which are recorded. Then the intergroup owings, which are cancelled, which are disregarded. Current tax. 300 plus 400. So we have total equity and liabilities. So if we do the entries, if we get these answers, this is 98. And this is 27, 2650. This is 71. This is 16. This is 3,000. This is 55. And this is 700. So even with the entries 1, 2, 3, 4, 5, 6, 7, 8, 8 out of 10. And even the first one without workings, you were supposed to get 8, 16 out of 20. Enough for a student. In our question, getting 16, That is more than 80% in our question. So you need around 4 questions in an exam to pass with the 16-16, then you do theory. So let's do this. Investment in Shika. So let's talk about investment in Shika. So we always start with the initial cost of investment. Remember that when Shika was acquired initially, you remember the investment was 24. So they disposed a half. So by the time it was an associate, the investment was 12. That is why you have the investment of 12, even from the statement of financial position. Then we add the share of post-acquisition profit. Share post-acquisition profit. And we can talk about the reserve. So post, you talk about 40%, 40%. So post, how do you get post? You take the balance carried down. So the balance carried down, you raise the balance as acquisition. Balance carried down minus balance as acquisition. So the balance carried down of the profit. Remember, we are talking about Shika from the statement of financial position. So you take the balance carried down as the statement of financial position. We have 3,000. Then as at acquisition, note 1, we have 1,500. When the retained profit of Shika amounted to 1,500. So 3,000 minus 1,000, 1,500, not even 1,000. 3,000 minus 1,500, because as at acquisition, it was not 1,000, but so 3,000. So we say 40% of 3,000 minus 15. So 1,500 of 40%, 600. So for the investment, it's 13 minus 12. Where am I getting this? So 13, where am I getting 13 minus 12? So the reserve I'm talking about is the reserve based on investment. So in addition, information number 2, from this point, they say this disposal had so when, let me read note 2. Unga Limited sold half of the investment in Shika for 1,500. This disposal has already been accounted for by Hunga, but not by the group. The fair value of the remaining investments in Shika was 1,300 on the disposal date, on the date of disposal. So the fair value of the remaining investment. And we know it was supposed to be, remember, initially it was 24. So disposing a half, it's supposed to be 12. But they are saying the fair value of the remaining investment in Shika was 13, instead of 12. They are saying that it's 13. So that is where I'm getting the 100 from. Then was there impairment? There was no impairment. There was no impairment. There was no impairment in this question. Then the last thing you are supposed to add back Yeah. Was there an impairment? There was no impairment. Then the undisposed goodwill. So after deducting the impairment loss, which was not there, then here we are supposed to add back undisposed goodwill of Shika is 100. So that here we have 18, 19, 1940. So that is what you record here, 1940. The last two workings, retained profit and NCI. So I think I can clear this.
Wait, teacher. Oh, that side, it's okay.
So initial cost of investment. So you are done with this working? Huh? Terry. You are done with this? Hmm? Anyway, remember that you will again interact with the recording. So maybe mahali utakuwa umeandika saa hii, you will again check based on the recording. So
I'm good.
Retain profits. We talk about retained profit balance brought down. So instead of repeating myself, I can just say balances brought down. So we talk about Hunga, Shika, Shuja. So then we add the profits. Profit paid by who? The profit attributable to parent. The one you got from the P&L. The last item in profit and loss. This is an income statement. It was 2555. Then we raise dividends paid by the parent. From the income statement, dividend paid by parent is just 500. Then for the retained profit brought down, Unga, from the income statement, you can see retained profit brought forward for 120. When was Shika acquired? Some times back, yes, this one must have a balance brought down. From that income statement, we have 2500. So 2500 minus 15. As at the time of acquisition, it was 15. So meaning that this 15 is inclusive of the 25, is inside the balance brought down. So that is 1,000, we get 800. Then for Shuja, you write 0. Because Shuja was acquired in the current year, at the middle of the year. There's no way it can have a balance brought down to be recorded here. A balance brought down is a balance rifted from the previous years. So if I take my calculator, so that I take 4120 plus 800 plus 2555 minus 500. I get 69.75. 69.75. Then finally, we do the NCI. Then we check if it's balancing. Finally, we do the NCI part. So I think you are done. I clear this. So then say, remember that it's for Shuja, because that is the one which was a subsidiary. So it has an NCI of 25%. So you talk about ordinary share capital and retained profit as net assets. So 25%, 25% of the net assets. So 25%, 25% of the net assets, 1,000, 250, 2,500, 2,500 over 0.25 over 2,500, 625. So what you include here is the goodwill of the NCI. But we don't have the goodwill of the NCI because we never use the full method in goodwill computation. Include depreciation overcharge. There is no overcharge because there is no set of fixed assets. UPS, but this is if upstream sale. There's nothing like that. We have depreciation undercharge. So we record if it's present. We don't have revaluation so that we compute for this. And finally, we record impairment. But impairment, if full method was used in
Teacher, didn't we had, it's not supposed to be added there, the negative goodwill.
No, that one you add it, already we considered it under the
But
income statement.
retainer, okay, so.
In the income statement.
Okay.
So this is 875. And this is 875. So balancing figure 875. What I have to include here, what you need to include here is the revaluation. The revaluation on investment, include it here. So the 40% of the 13 minus 12. The 40. 9,800 plus 1940 plus 2650 plus 7,100 plus 16. So this one is 23,090. 6,000 plus 6975 plus 875 plus 40 plus 3,000 plus 5,500 plus 700. It's the same, 23,090. So that is how you were supposed to do this partial disposal of subsidiaries. But for students, I always tell them that, or I always tell you that it's not all about balancing the question. Are you capable of at least getting 15 correct entries in the entire question? So focus on that, not balancing the question. You cannot. Utakuwa umejisumbua bure. Are we together? Are we together on that? I think whoever was taking notes, you can finish, as we call it, a session for today. So that when we meet tomorrow, I will do foreign subsidiaries. I will introduce foreign, how you are supposed to translate the foreign subsidiary, the items of the foreign subsidiary, using which method. This is the method which is recommended by IS 20, it was 21, yes. Even you can go and type IS 21. Some ways of it sort of our foreign subsidiary. Then we do around 2 questions. Then I think with time we'll do our best to finish cash flow, because that is now again another question which never misses in any paper. Any question before I end the Zoom session? Any addition? Any relevant contribution? So you can have a nice time and all the best. Let's meet tomorrow.
So thank you.
Asante.
Thank you. Good night.